Hi everybody, Jeff Yastine here. Make sure you hit the red button and subscribe to our Wealth Press YouTube channel, and also follow me on Twitter at Jeff Yastine, as well as on Facebook at JYastine1. So one thing I've noticed lately as the S&P 500 and NASDAQ drift higher here in August is the reluctance of many strategists on CNBC to call today's market a bubble. And I get it. The word bubble is used far too much. But that doesn't mean ignoring the warning signs either when the market gets overheated in one form or another. And I'll state my case in a few minutes with a closer look at the usual suspects that completely dominate the indexes, right? Facebook, Apple, Amazon, Netflix, Google, with Microsoft and Tesla thrown in to make my case. Now, why should you care? Well, for now, it's pretty clear that the trend for the market is higher. And that's likely to be the case for at least a few weeks more, if not through Labor Day weekend, in my view. But if you pay heed, you can position yourself to speculate with options and perhaps make a great deal of profit, and also perhaps sidestep a lot of the pain with your investments if and when stock prices start going in the other direction, which they inevitably will at one point or another. Now, when it comes to a bubble or not bubble, there's no comparison. This chart shows us the NASDAQ composite in yellow and the index's price earnings ratio in purple. And at the peak of the dot-com era, as you can see, the index had a PE ratio of more than 80. These days, it's closing in on 60. So are stock values as stretched as they were during the dot-com bubble days 20 years ago? No. But then again, tech stocks are trading at their highest valuation levels in 18 years, since May of 2002 to be exact. So buying these stocks today or ignoring the chance to speculate on downside opportunities with options because we're not in a bubble is no better of an excuse. Let's also remember that just because a particular asset isn't in a classic bubble doesn't mean a bear market, which always sneaks up on us rather than announcing its presence ahead of time, will cause you any less pain as that bear market sets in. For instance, when the last bear market struck in 2007, 2009, the stock market itself was not in a bubble. It was the nation's real estate market, or at least certain portions of it, here in Florida, Las Vegas, Phoenix, California, and elsewhere. That's where values had become wildly overinflated. Certain portions of the stock market, yes, were vastly overvalued as well. Banks and financial services companies were hugely popular back then, and they dominated the NASDAQ and S&P 500's capitalization levels the same way FANG stocks do now. But before the bear market of that era struck, the S&P 500 was trading at a relatively modest price earnings ratio of around 20. That's not super low, but you know what? It's not super high either. But as we all know, the fact that property values were out of whack in a handful of places, and not everywhere, did not keep the financial crisis from happening or the huge sell-off in stocks over the next 18 months. The NASDAQ and the S&P 500 both fell more than 50% during that time. So now let's go to today's stock market. Now, are there bubble-like valuations for today's overall stock market? No. But then again, our markets are dominated as never before by just 6 stocks. And if you add up the market capitalizations of those 6, they account for about half the value of the NASDAQ 100 index. In other words, if those 6 stocks weren't as attractive to own in the future for some reason, if investors decided they were overvalued, they decided that the stocks can't sustain their current growth rates, or the government moved to seriously start regulating them or break them up, those 6 stocks could do a lot of damage to the overall value of the major indexes, the NASDAQ composite, the NASDAQ 100, and the S&P 500. And the fact is, those stocks do trade at bubble-type valuation levels. And we can see that by comparing their stock prices against their profits per share or their sales per share that these companies generate. So what about Microsoft? Well, relative to the profit, Microsoft trades at its highest price to earnings ratio since the dot-com days. It's just very, very clear. It's a great company, but you're paying the highest premium to own it in 20 years at this point. Likewise, Google's PE ratio recently hit a peak of 35. Now, if a company has fast earnings growth, a PE ratio of that level can be easily justified. If its earnings are growing at 30% a year. But as you can see from the line at the bottom of the chart, that's compounded annual earnings growth, its profit growth is slowing down, not speeding up. It's the same for Netflix. Again, we're not talking about the actual stock price, but what that buys you if you own the shares or buy the shares now relative to the sales per share that the company actually brings in. So you're paying a huge premium relative to sales to own the stock. Likewise, for Facebook, you're paying the highest price ever, not just for the shares, because that's where they're trading right now, but for what each share represents in the way of the company's sales. And likewise, in order to own Amazon stock, you'd have to go all the way back to the year 2000 to see the last time that you had to pay a price to sales ratio as high as now. And finally, there's Tesla. Now, the company has proven its naysayers wrong. There's no question about that. But if you're buying the stock here, intending to own it for a long time, again, you're paying a price to sales ratio of 10. That's its highest level in nearly 6 years. So there you go. I mean, the stock market may not be in a classic bubble from a valuation term, but with these 6 stocks making up the majority of the stock market's performance in recent months, investors are relying on them to do more and more of the heavy lifting. And with stock values stretched to record extremes at this point, they may not be up to the task for too much longer. So just a word of warning there. If you like what I'm talking about, again, make sure to subscribe to our YouTube channel, follow me on Twitter and on social media, and I'll see you next time.